One of the fastest growing QSRs in India, Devyani International, is reaping the benefits of restructuring of business model, reducing store size, optimizing manpower costs and focusing on delivery business, leading to the company posting a profit in FY22 after a long gap. Being the largest franchisee of Yum brands, which includes KFC and Pizza Hut in India, Devyani has a huge runway for growth given the relative under-penetration of these brands in the country. It's aggressively adding new stores and is poised to more than double its earnings over the next 2 years. Devyani International posted a decent set of results in Q4 amid a challenging operating environment. Revenues were down marginally by 5% QOQ, affected by third wave of COVID-19 in the early part of the quarter. DIL stated that operating conditions were affected for about 5 to 6 weeks owing to restrictions due to surge in COVID infections. Despite the steep increase in raw material prices, DIL was able to maintain gross margins on both YOY as well as QOQ basis, primarily because of the price hikes taken by the company. Its EBITDA margins improved marginally on a sequential basis. Net profit improved QOQ as higher depreciation expenses were more than offset by tax credit owing to recognition of deferred tax asset. Devyani International will continue the aggressive store expansion strategy. Both KFC and Pizza Hut currently have about 650 stores each pan-India, which is much lower compared to 1,500 stores of Domino's. Despite the COVID-related headwinds last fiscal, it opened 236 net new stores for the core brands business, which is KFC, Pizza Hut and Costa Coffee. Now it plans to open about 250 stores every year for the next 2-3 years for its core brands. DIL would open about 100 stores for KFC and Pizza Hut each. Costa Coffee store addition would also accelerate as DIL has signed a new franchise agreement and it aims to open about 50 Costa Coffee stores every year. With business conditions normalizing, both KFC and Pizza Hut will focus on introducing new products. Pizza Hut's average daily sales is less than half of the market leader Domino's, and new product launches would be a key driver in bridging that gap. Introduction of new products would drive same-store sales growth as well. DIL is targeting a same-store sales growth of 4 to 5% for KFC and 7 to 8% for Pizza Hut. For Costa Coffee, it aims to reach average daily sales of about 40,000 rupees over the next 2 years versus 37,000 in the pre-COVID period. Devyani's key raw materials, which is chicken, edible oil as well as cheese, all of them have witnessed a sharp surge over the past few months. Furthermore, the increase in fuel prices has also increased input costs. DIL has undertaken price increases at the beginning of the fiscal to offset these cost increases. For the KFC business, it took a price hike of about 8 to 9% and a similar kind of a hike for Pizza Hut as well. DIL stated that the input cost increase has been unprecedented, and while it has passed on the full cost increase for Pizza Hut, it has not been able to do so fully for KFC. Devyani says it would take another round of price hike for KFC at the end of the current quarter if necessary. Increasing raw material prices would exert pressure on the margins. However, it would be largely offset by price hikes as well as operating leverage on account of fast ramp-up in store count. Now, at the current market price, the stock is trading at an EV/EBITDA of about 23 times its FY24 estimates. And we advise long-term investors to add the stock, therefore, to their portfolio.